Okay.
Right, and we are live, taking over the 50 plus and fabulous group.
Hello, everyone. Yep,
Hello.
yep. This will be so much fun. We've been so looking forward to this. So, yeah. Oh, okay. We popped up here. I'm just watching us on Facebook at the same time.
We'd love everyone to tune in, say hello, tell us where you're from,
Yeah.
and get some of these comments popping up at the bottom.
Yeah. Share, Max. We want to hear what people have to say.
Yeah, we got to get some people on here, get them reaching out. It always takes a couple minutes for people to log on. Hello, we got California here.
Great. And this has been, Sybil, we did a poll in the group to see what topics they wanted. And this investing piece has been really popular. So we're eager for people to come to the table or come to the live and join us here and get their questions ready.
Yes, yes. I'm excited. This is just the perfect time to get off the sidelines and invest. So very timely topic.
Yeah, really. And there's investing these days just seems so different than ever before. I mean, it's not hidden behind the black curtain or something like that. It used to be so mysterious. It's so much easier and exciting to watch, I think.
Yes.
Got some more people tuning on, so hello everyone. It's the Purse Strings Takeover Week.
Yep, we're taking over the 50 plus and fabulous group the whole week.
Everyone to be financially fearless is what we like to say.
Yeah, so we'll be here every day this week at 1:30 Central and sharing a different one of our Purse Strings approved providers for professionals. Kicking it off with Sybil.
Woo woo.
Very excited.
Yeah. And and thanks to Kim Kane. There's Cheryl. Hi, Cheryl. Yay. And thanks to Cheryl for pulling everything together. She has been working with both of myself and Maggie, and Sybil referred Sybil to us. So she's a powerhouse, Sybil at Females in Finance. And we're lucky to have her in our lives and as our cheerleaders, and she's doing so many great things for women as well. So it's really great.
All right. Should we start by introducing Purse Strings to the 50 plus and fabulous community?
Sure. Would you like me to kick it off then?
Yeah, that sounds great.
Well, welcome everyone to the 50 plus and fabulous takeover by Purse Strings. I'm the founder and creator of Purse Strings in partnership with my daughter, Maggie. So we're both here today because we're so excited to share our Purse Strings story. We created Purse Strings because we found that women really needed tools and resources and really vetted professionals to help them make really good financial decisions. Too often we heard women say they didn't want to talk about money, or they gave those decisions over to somebody else, either a spouse or a financial person or their brother-in-law, sister-in-law, without really having a voice in the decisions that are being made. So we created a Purse Strings model where we offer free online tools and resources, just like you're seeing today, to help women come to the table and learn how to be what we call financially fearless. I found that as I was navigating a divorce, there were lots of women who either were divorced or lost their husband and were not sure of how to manage their finances. And then Maggie, how about your experience?
So I did a lot of focus groups with Barb, and I learned kind of, the older crowd and their financial stories. And then when I went off to school and learned, lived with so many different roommates, but they were all females. And, I saw everyone else's different money stories, how they were approaching their finances with their new jobs. and how they were taking on student loans and the different perspectives people have, either, already kind of throwing in the towel or really preparing themselves for the future. So it was really interesting to see both sides.
Yeah. So what we're doing here is we want women to come to the table in the safe community called Purse Strings, where you'll get your questions answered. And also we'll provide you vetted professionals like we will today with Sybil Slade. And these are Purse Strings professionals. We call them Purse Strings approved because we are looking for only those financial professionals in anything money. So realtors, attorneys, financial professionals who are top of the tier, who really know the strife of women these days, which is a lot, and that's a whole nother webcast. But also, they're gonna really take what you need and listen to you and make sure that your questions are answered, that you're listened to, and that they serve you front and center and are not just gonna push you a product. So no sales today, no sales ever with Purse Strings, just knowledge and skill. Okay, Maggie, so, get over to you.
Let's start by introducing Sybil Slade. She helps professionals and small business owners increase their cash flow and personal assets through advanced tax saving strategies and investment strategies traditionally given to larger firms. This is all done with strong listening and no judgment. She works on making financial concepts simple and understandable, so you can really achieve your goals. She loves to coach and help monitor progress, both financial and non-financial. And we have to know when not working, Sybil loves to camp, reading, traveling, and riding her Harley. She escapes into nature, getting away from the hustle and bustle of life. Easy to understand.
It's awesome.
So I'm going to throw up these slides for you, Sybil, and just let me know when you want me to keep advancing them for you. So give me 1 second so I can get this all.
Awesome. Thank you, Maggie, and thank you, Dr. Barb. Thank you just for the opportunity to connect here with the Fabulous Plus, or 50 Plus and Fabulous Women. I am a part of the club, so I'm very excited to have this conversation today. So when we talk about investing, Ayn Rand, the philosopher, says, money is only a tool, and it'll take you wherever you want to go, but it will not replace you as the driver. And I think that is so important for us as women to really grasp that thoughts, that it cannot replace us as the driver. Money is the vehicle and investments is the road. And depending on the investment you choose, either the road can be hilly, curvy, straight, or it could be narrow. It really just depends on the investment that you choose. So it's very important to understand the investments that we get into. Now, before we get started, I want to ask you ladies, by a show of emojis, for those of you who have some investment knowledge, give us a heart. Let me kind of see who's out there and where you are on this spectrum. And then for those who have a little investment knowledge, I'm going to ask you to use the thumbs up emoji. Let us know, again, where you are on this spectrum. And finally, for those who have no investment knowledge, let us see the care emoji. And just so you know, this is a no judgment zone and a safe space. I just want to know kind of where you are on the spectrum. So as we walk through this conversation, it can be very meaningful for you. So with that, let's get started.
Just want to throw in there, you got a couple hearts, you got a couple thumbs up. So we got some little investors on our hands.
Awesome. Awesome. So with that, Maggie, yes, let's get the legal stuff out of the way. All right. This conversation is for educational purposes only. It is not considered to be an investment advice. And the views and opinions expressed during this conversation are my own. They do not represent Purse Strings. They do not represent Life Plan Financial Advisors or Securities America. All right, Maggie, let's keep rolling. So why invest? You invest for your future. If you think about it, if your money was just sitting right now in a jar under the mattress, your buying power has already diminished. So we really invest, firstly, just to outpace inflation, but then secondly, to make sure that we still have good buying power in the future. We are living longer. Many of us are finding out that retirement is a lot more expensive than what we thought it was. When you think about it, you go into Walmart and you see the greeters, they could be our grandparents. I mean, so we're finding out we're living longer. 30 years of retirement is not uncommon. My mother is in year 32. Okay, so we need it, and we want to make sure that our money, that we outlive our money, and instead of our money outlives us instead of us outliving the money. Sorry, got that one screwed up a bit there. And then also, we have to take responsibility for our own finances. Social Security may not be as robust for the next generation and moving forward. And then when we look at corporations have basically trimmed down all of their pension plans, and now they're forcing us to also contribute towards our retirement with a 401k plan. So everything is pointing back to us. So that is why it's important to invest. We want to be able to live comfortable in retirement, comfortable in our future, and be able to provide this comfort for ourselves and our families. All right, Maggie. Now, let's talk about the types of investments. So, firstly, we have stocks, and many of you have heard of stocks. And stocks is essentially where a company allows you to now be a part of the company, a part of the corporation. Now you're buying shares of stock so that you can have ownership in the company. This is how they raise capital. And the types of stocks could vary. It could be income paying stock. It could be value stock that's at a discount. It could be growth stock where you're expecting great returns. It could be speculative. This is where you're taking on a lot of risk and expect to receive a lot of return. It can be cyclical, like consumer luxuries. We typically buy cars and other fancy things when the economy is going well, but when it's not going so well, we don't buy those items. And then there's defensive. And these are the things that consumers are going to buy regardless of what is going on in the economy. We're going to buy laundry detergent. We're going to buy bar soap. We're going to buy certain things regardless of how the economy looks. So that is what stocks are. Then we have bonds. Bonds is a little bit different. Now, you can have private corporations to issue them as well as government municipalities. And with the bonds, essentially, what these entities are doing are asking you for a loan. And they're basically saying, if you give me these dollars for this bond at a discounted rate, I will repay you what is the face value on this bond when this bond matures. So essentially, you are creating a loan to these entities, and you're paying a little less just to get the actual face value when the term of the bond is up. And then we have mutual funds. So mutual funds is really a laundry list of stocks. So for example, I may have Coke and I may have 10 other stocks in that mutual fund. There are separate stocks being held inside the mutual fund. And then there's a whole group of investors who are also invested in that mutual fund with me. So I am diversified with the types of stocks that are held inside the mutual fund. And I'm also diversifying my risk because now maybe it's me, Maggie, and Barb, and Cheryl, all of us, everyone who's invested in that fund, we are sharing the risk among each other. So that is how mutual funds work. And then we also have other types of investment. That can be annuities, that could be gold, that could be antique, etc. Now, we're not going to cover the other types of investments today. We're going to kind of stick to the first three, some of the typical investments that most people are aware of. All right, Maggie. Now, let's talk about how to create money momentum. Essentially, your money should be operating in 4 buckets simultaneously at all times. Most people become a little gun shy when I say this and they think, oh God, well, I haven't been doing all of that. But typically most people are already operating in 2 of these buckets. So let's walk through them. I'm going to see if I can get my mouse to show a little bit. It may not, you may not be able to see this. Okay, thank you, Maggie. So in the first column, this is your short-term bucket. This is any dollars that you will need in the next 12 months. Maybe you have some type of short-term goal in addition to your emergency savings, and certainly that should be a goal as well. But in that bucket, you could have cash, you could have a savings account, you can have a checking account, and certificates of deposit. And so these are all investment vehicles that you know within 12 months that you may potentially touch for a particular expense that you may have. Maybe you have a child in college and tuition comes up. And so you're just going to leave money in a certificate of deposit so it can grow a little interest, but in 6 months, you're going to cash it in so that you can pay for tuition or books, etc. But then we go over to the second column, and that's the midterm bucket. In that bucket, this is anything that is greater than 12 months and less than 5 years. This is something that you will not touch this year. You will touch it this time next year or later. And this would be where you could, again, have certificates of deposits, what we know as CDs. You can have a money market account, which is essentially a high interest checking account. And so in this account, you put dollars in to earn a little interest. We just want to keep up with inflation at best if we can. And then there's a certain number of checks that you can write on it per month. So this would not be like your everyday checking account, but maybe you pay your car insurance quarterly or something of that nature. So you're limited to the number of checks you can write on that particular account. And then equities is the same thing as stocks. We just covered that on the previous slide. So you can have stocks in that bucket. And typically, at a minimum, that's where you want your stocks to start. The reason why is if you sell them in less than a year, you're going to be taxed at your normal income rate at a higher rate. Okay, and so that's why we have that in this bucket versus the other. And then you have mutual funds. Same deal there. You want to be able to hold it for the long-term capital gain. So you got to have it at least 1 year in that bucket so that you won't pay fees for redeeming and extra taxes. Okay. Then we have the third bucket, which is your long-term guaranteed bucket. This is where your Social Security would be and pension. And why do we call this guaranteed? Because you know every year exactly what amount you will receive if you're on a pension or if you're receiving Social Security benefits. It's guaranteed that that is what you're going to receive. And then, last but not least, we have another long-term bucket. Again, this is greater than 5 years. And in it, you will have what's called individual retirement accounts. This is an account that you can put up to $7,000 in per year for retirement. And it is a tax-deferred account. Then you have a Roth IRA. That's another type of individual retirement account. And in that account, that is where the dollars are put in after taxes. So it grows without being taxed ever again in the future. And then we have equities again. Again, that's stocks. We have mutual funds. And then we have annuities. And then we have permanent life insurance. A lot of people don't see permanent life insurance as an investment vehicle, but it is. If it's not a term policy and there is a permanent component to it, there's a sub account, which is an investment account. And those dollars are marked towards an index to give you a return. So you'll have cash value in that policy as well as the death benefit. Now, let's talk about a couple more alternative strategies here at the bottom. So as I alluded to earlier, most people at least have something in the short-term bucket and in the long-term guarantee. You either have cash savings or checking, or you have Social Security. Now, with the alternative strategy, when we look at the Roth IRA, a lot of times I have people who say, I really need to save for retirement, but I don't have emergency savings. And so how can I do both? Well, that's when I typically suggest the Roth IRA, because with the Roth IRA, whatever dollars you put in there today, which is your principal, you could take back out tomorrow if need be. So if an emergency comes up in a month, you can take it back out with no penalties. It's the earnings. If you take more than your principal and you take a portion of the gains that you've had, that is where you would pay the penalty. So the thing is, if you start this Roth and you say, I'm going to fill 2 buckets, I'm going to fill my emergency savings and my long-term savings. If you never have an emergency and never have to tap into that Roth, guess what? Then it's there for retirement. But if for some reason, some emergency come up, some huge car repair, etc., you have that emergency bucket with that Roth IRA. So that's how you can kind of spread that to fill 2 of those buckets at once. The annuities, that is another tool where maybe your company is not offering you a pension. Maybe you've paid so little into Social Security, but for some reason you need or have to retire, but maybe you have sold a home in another state and you moved south and became a snowbird. Well, you can take some of those dollars and put it into an annuity and create your own pension so that now you have a guaranteed income stream in retirement. That is what's called living benefits. They have riders now where you can now create your own pension. So these are just a couple of other alternative strategies that you can use in the entire investment spectrum. All right, Maggie.
Yep. So I'm going to jump in here because we got a couple questions
Sure.
users have asked. So the
Okay.
first one is are money markets available through banks, or is it something that you have to go to an investment person to set up?
It is available in both places. I typically send my clients to their bank. Just unless there's just not really good return and it's a better return with looking at the money market that we have. But the reason why I do that, if they need to write a check or they need to literally physically go into a branch, they're going to be able to address that emergency a lot faster than going through me and my back office to do the redemption. Now, it could be done, there's wiring and EFT and things can happen in a day or two, but maybe they literally need it that day. It's an emergency they need to address that day. So I prefer for them to be able to kind of have that local access to their money market account. Great question.
And then we have another question. With permanent life insurance, is it something you can still acquire after 50 years of age?
Yes, it is. And it could be an expensive option, but you certainly can buy it at 50. Certainly, if you bought it younger, it would be a little cheaper. But yes, you can still get it at age 50, and it's still not too late. I've seen where people wish at 50 they had have decided to go ahead and buy a permanent policy because they don't have the means to pay for their final expenses. And they only had a term policy, and the term policy annual renewal amount, the premium is so expensive they can't afford it.
All right, that's great. And I mean, great advice. And then I know you said that money markets, you recommend going to a bank. Some of these other investments, where would you recommend people to go?
So for other investments, certainly then that's when you would go to a financial advisor or a investment advisor. You would look for a financial professional. As a matter of fact, my next slide talks about how to get started. Maybe we should go there to.
All right, sounds perfect.
And you could also get a financial planner as well. But there are key questions that I would certainly stress that you would ask those individuals. So certainly you want to know what type of licenses they have. You also want to know their areas of expertise. Are they really experts in an area that you need an expert for, because maybe you have some tax consequences, maybe you're dealing with aging parents and you inherited things. So you kind of want to make sure that you have an expert that can assist you with whatever your financial goals and needs are as it relates to your investments. You want to know their designations, whether or not they're fiduciary. And so fiduciary, is basically a person who's held to the highest standard. They're a person who has to make sure that they act in your best interest. There are a lot of things that are suitable. So that's different from, is this suitable for me? There's a lot of things that can be suitable for you. There could be 5 things, 5 options I could share with you that are actually suitable. And I could defend each one. But only one of those may be literally in your best interest. So you need a person who can drill down through that and make sure that they're literally acting in your best interest. Any more questions, Maggie?
Yeah, we do have a couple more. How would you recommend taking Social Security at 62 or wait?
That is a very, very popular question. And unfortunately, it's one of those where you give the "it depends" answer. So certainly if it really depends on your situation, if you're single, if you're married, if you were a government employee or not. There are a lot of different formulas that come into play based on you and your spouse's Social Security amounts. And if you're a government employee where you may have not paid into Social Security, and there's going to be some deductions to your household income together around the Social Security formula, then you may, in some of those cases, decide to go ahead and take it before your actual retirement date kicks in. So there's a lot of it just depends around that, honestly. So I can't give a blanket answer. There are some cases that yes, 62 makes sense, but there are a lot of cases where it does not. It's probably my best answer.
I want to share with the audience that I believe it's on Wednesday. We will have a professional who will be talking all about Social Security. So we will gain more information on that later this week.
Yes. Thanks.
Another question, is there one investment you would recommend over the others once you retire and your money is now considered fixed each month?
That's a great question. And again, it's going to go back to depend, and the depending variable in this case would be your risk tolerance. I always feel that even if you are on fixed income, you still need a growth component. Now, how much of a growth component depends on your risk profile. But we don't know how long you're going to live. You do need some element of growth. And when you start taking distributions, when the government requires you to take that 3.6% out of your retirement assets every year, in a down economy, you will spend down quickly. In an up economy, it's fine, right? So for me, I want to ensure that you still have some element of growth, even when you're retired, because we don't know the economic cycles. All we know is that out of 10 years, there's going to be 3 years of turbulence. We just don't know which 3. And so we want to make sure that there is some element of growth components in your retirement portfolio, even if you're considered on fixed income and you're using fixed assets. We do want some degree of growth.
And is there a way to measure the risk of these different investments?
So there are a lot of tools that kind of go into creating these risk profiles for the investment. So typically, if you're sitting with a professional who is going over these investments with you, they're able to show you what the beta is and what does that mean. They're able to show you how this risk is classified for that particular investment or that particular mutual fund. So there are a lot of consumer tools that the advisor can use to explain this to you. So yes, every investment has some degree of risk. And so it is important that you sit with someone who understands these, can explain them to you. And again, go back to taking your risk profile. They actually go through this battery of questions that they have you to answer to really determine if you can stomach the risk. A lot of people say they want growth and they want to be aggressive, but by the time they finish that risk profile, they show up on paper a lot differently. And so that's what first before they ever show you investments.
All right, I'll let you get back to your slides now.
So here's how you can stay connected with me on social media. I'm Sybil S. Slade on all platforms. You see on the ticker below, there is my website. If you want to reach out to me there, you can do that as well. At Life Plan Financial Advisors, we do offer a free financial discovery conversation. You can go there, find the book a meeting button, click on it, find my calendar, and schedule a time. And then we can really drill down into some of these questions. When I said it depends, that's where the individual discussion literally happens in those financial discovery conversations. So thank you for your time and attention today. And I don't know, I think Maggie, you can see all of the questions. Are there any other questions that I can potentially answer?
Yes, we do have another question here. With interest rates so low, would you recommend lowering or looking into refinancing your home to receive dollars to save or invest?
Great question. So I would have to ask a couple of more questions. Again, back to those situational things. That's why you do want the financial professional somewhere in the equation. Are you going to stay in your house for more than 2 years? How much would you literally be saving? If you're saving 2% or more on that interest rate and you're going to stay there for 2 years or more, it may make sense. But if not, it may not make sense because of the expenses that you're going to spend on refinancing. You may not recoup if you move out in 12 months. So it's really a overall financial question that we would have to answer in that case. But certainly if you're going to stay there longer and the numbers work out well, then yes, it would make sense to refinance if you're going to really save and be disciplined to do the reinvesting. I think that's the other part of the equation. When people do this, they typically don't take that 2 or 3 or 4% that they've saved and now reinvest it. They enjoy the cash flow and have a little lifestyle creep. They redecorate a room or do some remodeling. I'm just being honest.
Yeah. Yeah.
Yeah.
Mags, can I jump in?
Yeah, go for it.
I have a few questions. Sybil, this information is so valuable, and I know we just really scratched the surface. What we wanted to provide today are some foundational considerations to think about when you start thinking about investing. And you can see how it's really unique to every person. Great questions were asked, but yet, like you say, it depends because you need to look at the whole picture. Yeah. So I know this is your area of expertise. Are you considered a financial advisor or a fee-based planner?
I am a hybrid.
Okay. Can you share a little bit about how that works and how people pay for your services?
Sure. So if you want financial planning or consulting or coaching, then that's fee-based. Now, if you decide that you want to do investments, then that is where the hybrid comes in. It's really dictated on what the transaction costs are by the host family for that particular product or investment product that you're going in. And so then I'm paid a commission from them and they charge you a fee.
Got it.
For investing in that product. So because I have both ends of the spectrum, honestly, I don't just solely do planning. I have people who do want to invest and not plan. They just want strategy. And so they'll pay for a consulting fee for that strategy, and then they go ahead and implement the investing for themselves. And then some say, well, no, I want you to do it too, because I still want to be attached to an advisor. Mm-hmm. And like I said, that fund family, if it's an advisory account, they're paying me the advisory fee from what they're already charging the client.
Got it. And what I think is so interesting about that is how all of the wisdom and knowledge a financial professional brings to the table can really make any fees kind of null in a sense, because you're really getting such valuable investment information, like the mortgage question, should I, let's look at the whole picture, because your house is an investment. And so you need to say, the mortgage rates are amazing. Is this a time for me to refinance? And you want to step back and look at the whole picture and see what other investments you have and other goals. What are your goals? So everything kind of ties into each other. It's not really easy to answer a question about one investment without seeing the whole picture.
And Barb, you touched on something really big. Most people think I'm going to pay for retirement with a 401k. But the reality is, outside of Social Security, they're doing it from their personal assets. So yes, you have to look at everything that you've invested in as a part of that personal asset equation that's going to take care of you in retirement. And certainly you're right. Your home is a part of that. And so if we keep extrapolating the value out, it's not going to be there for us in retirement.
Right. So as I think about my daughter Maggie, as she starts making purchases and investments, she wants to build and be in a place where she has either a home, or now we, are having children, or we're getting a bigger house, or we're getting more toys, if you will. But as I'm divorced, I did the opposite. I downsized because I didn't want the huge commitment and maintenance of a house, which is a whole nother cast we can talk about. And my finances are quite different. So where some are really building over the years, others of us are really trying to dial back on some of that and refocus our monies in a different way. And by engaging with a financial professional who can help you across your journey, can really help you be what we say is financially fearless.
Yes. Yeah. You can sleep at night.
Yeah. Right. Sleep at night and know that, the average age of a widow is, I think, like 59, which is much younger than we think. And divorce is 50%. So another reason we created Purse Strings is because we didn't want women to be kind of deer in the headlights. What do I do now that I'm in this situation and never attended to any of these discussions before? So Purse Strings is about providing free resources and tools and working with professionals such as yourself so that they know they have a plan in place, and at any point in time, they have what they need to navigate their lives.
Yes. Yeah.
Okay. Are there other questions, Maggie?
So far, no other questions have coming through. Just so many great people love this, saying it's so valuable, so enlightening and empowering. So, it's really great information just to really arm ourselves and come to the table and really own our finances. So we can stay on here just a little bit and see if anyone else has any questions that they have. But then, we always recommend to go to a Purse Strings approved provider, like Sybil, who will tell you her honest opinion and will give you what's really best for you, rather than just selling a product or pushing you a product or just trying to make a profit. She'll look at you, she'll talk to you, and care about you, which some people say they haven't received before. So, it's pretty exciting and can be pretty empowering stuff.
And a man is not a plan, as I've told many people who thought it was.
Yes. So true. And you alluded earlier, Barb, to the great divorces. Last year, I had to deal with 2 of those, and it was kind of heart-wrenching to see someone who has built a life together. And I don't know if you've seen the numbers, but for men, they really take about a 25% decrease in their lifestyle. For women, it's over 40%. That's scary. And to see that firsthand was just heart-wrenching.
Yeah. And, I remember shopping at Target with Maggie, and I just had it. This woman who was in retirement age was bagging my groceries. And I just wanted to hold her hand and say, do you love doing this work, or do you have to do this work? Because you should be really enjoying your retirement. And I said to Maggie, I don't know why this is happening, but I'm going to find out. And this is something that is important to me. I don't want to see this anymore. I want women to live a financially fearless lifestyle, and it's about empowering themselves with knowledge and skill around their monies. So that's why Maggie and I together built Purse Strings.
We had one more question come in. And what are some of the common mistakes people make?
I think we just talked about one of them to ad nauseum. It's really trusting, your partner or better half with all the financial decisions. Not that you can leave it to someone else to execute it, but you want to be a part of the conversation. You want to understand and know where things are going. So that's definitely one, like, don't be afraid to be a part of that conversation. And another thing I would say is when Barb was talking earlier about, having these goals and these investments, is if you're sitting down with a professional and they do start making recommendations, make sure that they can draw a very distinct line for you between what they're recommending and how it gets you to that goal. If not, ask questions. You really need to be able to see why X will get you to Y.
Mm-hmm.
Please
and
do
they
that.
have to be able to explain it to you.
Yes.
And really articulate it to you and answer all your questions. I can't tell you how many women have said to me, they don't look at me. And whenever I ask a question, they'll say things like, don't worry. They feel very dismissed. So enough of that. This is what Purse Strings is all about, is providing you with proper resources that are really going to be, what I say, part of your financial team. At any point in time, you're going to need a financial professional, you're going to need a realtor, you're going to need an insurance person. And we're bringing to the table those financial professionals who, like you, Sybil, make it a mission to really ensure that their clients have exactly what they need and are explained and answered all questions.
And then another thing would be estate planning. When you talk about mistakes people make, get your estate planning done. You don't have to have a lot of money to actually need an estate plan.
Right.
If you have children, you need to tell the courts what you want done with your children. We all can go in a courtroom and put on a great show and look like the most responsible person in the world. And then the judge sends your child out with me, who's the most horrible custodian that your child could ever have. So make sure that you can speak from the grave and protect your children and protect your assets.
Yes.
So that is another huge area where people just don't update their beneficiaries as life changes happen.
Yes.
Those are things that we have to remember to do. I've seen the wrong person getting all the benefits and the spouse is sitting there saying, but he's been married to me 20 years.
Yes.
He never changed the beneficiary.
Yes. And we're going to have another one on that exact topic, like what beneficiaries, what documents you need to take a look at. I do want to mention that the Purse Strings website is pursestrings.co. You can go there for resources and tools and join our Facebook group. It's Purse Strings for Financially Fearless Women. And we do have a live every Thursday at noon Central that we have a different topic every Thursday. But fortunately, in this fabulous group, we'll be here all week. 1:30 Central. Yeah.
So thank you, Sybil. It's been great. You can check her out at lifeplanfin.com. She also has her own page on the Purse Strings website under our approved providers. You can follow her on Facebook, Instagram, at Sybil S. Slade, correct?
Yes.
All right. So thank you, everyone, for joining us today. We're so excited for this Purse Strings takeover and can't wait to see everyone tomorrow. So thank you.
Thanks, Sybil.
Thank you. I appreciate it.